let's tear right into the highly lucrative cash flow machinery of Hess Midstream. This is a fascinating energy infrastructure play, and it operates by a completely different set of rules than your traditional oil stock.
So right off the bat, you've got to understand what Hess Midstream, or HESM, actually does. They don't drill for oil. They take on zero of that massive exploration risk you normally see with upstream energy companies. Instead, think of them as a highly integrated, fee-based toll road. They sit perfectly between the producers pulling the resources out of the ground and the downstream markets waiting to buy them. They gather, they process, and they provide the terminaling infrastructure right in the heart of the prolific Bakken and Three Forks formations up in North Dakota. Basically, every single time a barrel of oil or cubic foot of gas moves through their system, they collect a fee. It's a wonderfully simple, yet absolutely vital business model.
Now, you might assume an energy company operating in the Bakken is completely tied to crude oil, but management has actually engineered this massive strategic shift toward natural gas. Gas gathering and processing are projected to make up roughly 75% of their affiliate revenue all the way through 2028. Crude and water operations just make up the remaining 25%, and this matters immensely. Natural gas infrastructure provides these highly attractive, long-lived, and incredibly sticky recurring fees. It creates a baseline of revenue stability that is just incredibly hard to find anywhere else in the energy sector.
That strategic shift is exactly why HESM is fundamentally way more defensive than your standard exploration and production company. I mean, the contrast is night and day. Think about a typical oil producer. They have very high, direct exposure to commodity prices. If oil tanks 30%, their cash flow takes an immediate, brutal hit. But HESM? They have remarkably low direct exposure because, again, their contracts are fee-based. They don't own the hydrocarbons they're moving, they're just collecting the toll. Plus, where typical oil stocks are super capital heavy, meaning they're constantly bleeding cash just to keep the drills running, HESM boasts high free cash flow stability, and their capital intensity is actually falling sharply.
And that defensive setup leads us to what is arguably the single biggest financial catalyst for the company right now. See, for years, HESM was in this heavy, multi-year infrastructure build-out phase. Almost all the cash flow they generated had to be plowed right back into the dirt to expand their network. But that phase, it's largely over. The inflection point is officially here. Now, all that cash flow is being aggressively redirected away from infrastructure investment and straight into shareholder returns. We're talking distributions, share buybacks, and debt reduction. The harvest season has definitely begun.
To really put that shift into perspective, just look at their budget. $105 million? That is management's incredibly low capital expenditure guidance for 2026. For a company of this size, that's basically just maintenance mode. And to give you a sense of how fast this is dropping, their Q2 2026 CapEx was just over $30 million. That's down 56% year over year from Q2 2025. The heavy lifting is done, and the checkbook for new construction has effectively been slammed shut. Now contrast that tiny $105 million expense with the cash coming in the door, $910 million to $960 million. That is HESM's massive adjusted free cash flow guidance for 2026. Just think about that math for a second. You've got a business spending barely over $100 million on capital, but it's generating nearly $1 billion in pure cash flow. It's literally a cash printing machine at this stage in its life cycle. But to truly grasp the investment thesis in this explainer, we have to talk about the massive corporate restructuring that went down recently. 2025 was a total watershed transition year for HSM's ownership. In May, Global Infrastructure Partners, GIP, sold off its entire interest in HSM. Then, just 2 months later in July, the global energy titan Chevron completed its massive acquisition of Hess Corporation. This completely reshaped the board. Today, Chevron acts as the primary strategic sponsor. They indirectly hold roughly 37.9% of the company and control the general partner board, while public investors make up the economic majority. Now, having Chevron as your sponsor is the ultimate double-edged sword. I mean, the major advantage is obvious, right? You are backed by one of the largest integrated energy companies on the planet. That brings enormous financial resources, rock-solid credit stability, and deep strategic sponsorship. But the major risk is just as obvious: heavy, heavy dependence. HSM's future is inextricably tied to Chevron's specific development plans for the Bakken. If Chevron decides to pull back on drilling there, HSM's throughput volumes will absolutely suffer. So the real question you have to ask yourself isn't, will global oil prices go up? The real question is, will Chevron keep producing enough hydrocarbons in this specific basin to keep HSM's infrastructure fully utilized?
Let's play that out and see how this indirect commodity exposure works in the real world. What actually happens to HSM in a $50 versus a $90 oil environment? Well, at $50 a barrel, Chevron might get really selective and significantly slow down their drilling pace. So volume growth for HSM could stagnate. But here's the beauty of those fee-based contracts. HSM's revenue doesn't fall off a cliff. Their dividend stays heavily protected even while the broader oil market is panicking. On the flip side, at $90 oil, Chevron's drilling economics are fantastic. They pump more, Bakken volumes surge, HSM's utilization maxes out, and the value of their existing infrastructure skyrockets. They win big in a boom, but crucially, they survive comfortably in a bust.
Building on that stable foundation, management's growth projections tell a seriously compelling story. We're looking at a projected 5% annualized growth in EBITDA, which is essentially their core operating earnings, compared to a massive 10% annualized growth in free cash flow through 2028. Notice the disconnect there? HSM doesn't actually need explosive 15 or 20% top-line operating growth to deliver huge value for shareholders. Because their capital spending has fallen off a cliff, their free cash flow gets to grow at double the rate of their core earnings.
And that brings us to the big, pressing question for any income-focused investor analyzing this asset. Is a roughly 8% annualized distribution yield actually sustainable? Based on their Q2 2026 payout levels, they're distributing an annualized $3.15 per share. Now, in a market where truly safe yields are pretty tough to find, an 8% payout naturally triggers some skepticism. Can they actually keep those checks clearing month after month?
The answer appears to be a resounding yes. Not only is it sustainable, but management is actually targeting a minimum of 5% annual distribution growth all the way through 2028. And here's the absolute kicker. That growing dividend is fully funded by their adjusted free cash flow. In fact, it's so well funded that even after paying out that massive 8% yield, management expects to have a cool $1 billion in cumulative extra free cash flow left over through 2028. They're using that massive surplus to actively repurchase Class B units and aggressively pay down debt.
Let's talk about those buybacks for a second, because they are a massive hidden catalyst here. HSM has a somewhat unusual corporate structure. When they execute these accelerated share repurchases, and they've been doing this aggressively, pulling hundreds of millions of dollars of units out of the market, they permanently cancel those shares. By shrinking the total share count, the remaining public shareholders automatically end up owning a larger and larger slice of the business's total economics. So your free cash flow on a per-share basis is actually growing significantly faster than the company's total free cash flow. You're basically getting richer simply by holding your ground while the company buys out your neighbors. It's just financial gravity working in your favor.
However, no deep dive is complete without a hard look at the downside, right? The elephant in the room is a potential Chevron production cut. Like we talked about, if their corporate sponsor pivots away from North Dakota, the entire volume thesis weakens. Secondly, there's the risk of a long-term geological decline in the Bakken Basin itself. This is highly geographically concentrated infrastructure. You can't just pick up a pipeline and move it to Texas. This extreme customer and geographic concentration means a localized problem instantly becomes a company-wide crisis. And finally, as a yield vehicle with debt, higher for longer interest rates could easily squeeze their market valuation and drive up refinancing costs.
So how do we actually price all of this? Let's break down 3 fair value scenarios. In a bear case, say volumes stagnate, Chevron pulls back, and the valuation multiple compresses, fair value probably sits between $32 and $36. The base case assumes modest 1 to 2% gas volume growth, that targeted 5% EBITDA growth, and steady debt declines. That puts fair value between $43 and $48. In a bull case, where the Bakken strongly outperforms and the market finally awards HESM a premium infrastructure multiple, we're looking at $52 to $58 a share. With the stock currently trading around $39, it's sitting quite safely below those base case expectations, which offers a very reasonable margin of safety.
But if you want to know why this asset is truly compelling, just look at this number: 18 to 19%. That is HESM's jaw-dropping free cash flow yield, calculated against its current roughly $5 billion market cap. I mean, let that sink in. For every $100 you invest, the underlying business is generating $18 to $19 in pure, unencumbered cash flow. To put that in perspective, it's like finding a high-yield savings account on absolute steroids. This metric alone proves that HESM is not just some simple, sleepy dividend stock. It is a high-octane cash compounding vehicle.
Bringing it all together, the final analyst scorecard breakdown tells a really clear story. Free cash flow generation earns a near-perfect 9.5 out of 10. Revenue visibility, thanks to all those long-term contracts, hits a 9 out of 10.
Overall business quality is a very solid 8.5. The glaring weak spot, unsurprisingly, is customer diversification. That drags in a dismal 4.5 out of 10 due to the total reliance on Chevron. But even with that concentration penalty, the sheer mathematical power of their cash flow mechanics earns HESM an impressive overall score of 8.4 out of 10.
This quote really hits the nail on the head and summarizes the core thesis of this entire explainer perfectly. HESM doesn't need the Bakken to boom, it needs Chevron to keep the infrastructure well utilized, while HESM converts an increasingly low capex asset base into shareholder cash. You aren't betting on some massive new oil rush here, you're betting on steady utilization. If the status quo holds, a buy and accumulate strategy where you reinvest that hefty dividend could realistically yield a 12 to 15% annual total return over the long haul.
I want to leave you with this final thought to ponder. The financial machinery here is incredibly sound. The heavy lifting is done and the cash is absolutely flowing. But if falling capex virtually guarantees this immense free cash flow, the only question left for you as an investor is this: will Chevron keep the Bakken taps open long enough for you to collect it? You've got to weigh those incredible, tangible cash yields against that undeniable, overarching concentration risk. Thanks for tuning into this deep dive explainer, and as always, keep asking the right questions.